Real estate professional status is one of the most powerful but misunderstood tax strategies in the entire IRS code. It's the reason why some married couples are legally wiping out $20,000, $50,000, and even $100,000 in taxes every single year. But here's the catch. Most people get it wrong. They think that owning rentals is enough, or worse, they try to implement and claim real estate professional status while working a full-time job. In this episode, I'm breaking down what real estate professional status is, how it works, who qualifies, what disqualifies you, and the 5 mistakes that get people audited. If you stick with me till the end, I'll show you how one couple uses strategy to save nearly $100,000 in a single year. And if you need to know if you qualify, go book a free discovery call at bristertaxlaw.com, and let's make the IRS work for you, not against you. Welcome to the Wealth Planning Podcast with Brister Law. I'm your host, Anthony Brister. I'm a tax attorney, wealth strategist, and founder of the Brister Law Firm. And my firm helps high-income earners and real estate investors build tax and wealth strategies that protect and grow what they've worked hard to earn. And today's topic is a strategy that most CPAs don't even talk about, and most real estate investors don't really fully understand. And that's real estate professional status, or REPS for short. So let me start with a real story from one of my clients. I had a family who the husband was a surgeon making over $700,000 a year, and his wife was a former nurse who stepped back from work to raise their kids and manage a growing short-term and long-term rental portfolio. They had multiple properties, they performed cost-seg studies, but they were sitting on over $100,000 in passive losses, and their CPA told them that they couldn't use those losses to offset their income. And that might be true if you don't qualify for the real estate professional. So we dug into the wife's activities. She was managing the bookings, handling cleanings, scheduling repairs, ordering supplies, and she was tracking all of her hours, and she had well over 750 hours, and real estate was her primary occupation. So that year, we used REPS to turn $235,000 paper loss into tax deductions, and the result, they were able to save over $92,000 in federal taxes and kept more of their cash to reinvest into the next property. That's huge when you compound that year after year. The real estate professional status is defined in the tax code, and it allows you to treat real estate losses as active instead of passive. But why does this matter? Well, because under passive loss activity rules, high income earners typically can't use rental losses to offset their active income. But with REPS, those losses become fully deductible. This means that you can use bonus depreciation from that cost-seg study. You can write off the renovation cost. They all can be used to reduce your earned income legally. And for many of my clients, that translates into tens of thousands of real tax savings. How do you qualify for real estate professional status though? So to qualify as a real estate professional, you need to meet both of these criteria. First, you need to spend more than 750 hours in real estate activities per year. And then second, it must be more than half of your total working time. So that means if you work 2,000 hours in another job, you need to work 2,001 hours in real estate just to qualify. You can't double count, and the math has to make sense. So if you're working a full-time job, you're likely not going to qualify by yourself. Let's talk about where people go wrong with this strategy, because this is where the IRS catches people slipping. First mistake I see is people having a full-time job elsewhere. Like I said, you can't work a 9-to-5 at a law firm or a hospital and also can't claim that you're a real estate professional. The IRS will ask, when did you sleep, right? Second mistake I see is people think that owning rentals by itself is just enough. Reps is an activity, not just ownership, and you must materially participate too. So just having that rental property isn't going to be enough. Third mistake that I see people make is they try to combine hours as a couple. So for reps, only one spouse can qualify, and that spouse must meet the 750 hours and 50% test on their own. But if they do, both get the benefit on a joint tax return. Another mistake I see is they forget that short-term rentals have separate rules, and they confuse reps with short-term rentals. Short-term rentals don't follow the same rules as reps, but you can benefit from those losses. The problem is they require more material participation. And that's another strategy, but if you want to check out this video right here, you can get more on the short-term rental loophole because it is a powerful tool. So let's talk about the pros and cons of rep status. Pros are, one, you get to use the losses to offset your high income or W-2 business income. This supercharges your ROI, especially when you pair it with a cost seg to speed up the bonus depreciation. You get to keep more capital to reinvest in real estate, and only one spouse needs to qualify. Some of the cons are you have to track your time and document and substantiate, and it's not available if you're working full-time elsewhere. And if it's done wrong, this can trigger an audit. I see people get sloppy all the time. Here are the 5 mistakes that get people audited when they use real estate professional status. First, they don't have a time log or documentation. Second, they try mixing passive and active investments like syndications. Third, they don't make grouping elections for multiple properties. Fourth, they try to claim hours for tasks that don't qualify, like travel time. And then fifth, I see people trying to back into the numbers during tax season instead of planning ahead. If you're going after reps, you need to do it right and be proactive. Real estate professional status is one of the few legal tools in the tax code that allows you to control your tax outcome. It's not a loophole, it's a strategy that can save you thousands, but only if you play by the rules. Most people fail because they don't track the hours, they don't plan ahead, or they assume that their CPA is taking care of it. But the truth is, this is your responsibility, and the reward is massive if you get it right. You don't have to be wealthy to use this. You just have to be intentional and proactive. Now, if you've ever felt like you're doing everything right and you're still handing too much to the IRS, this is your next move. If you're a married couple investing in real estate, and especially if one of your spouses is hands-on, real estate professional status might be the key to wiping out your next tax bill. Go to bristertaxlaw.com, go schedule a free discovery call, and let's see how much you qualify and how much you could save using this strategy. You don't want to leave 5 or 6 figures on the table. And if this episode helped you, please share it with a fellow investor or a high earner, because this strategy could change the trajectory of someone's financial future and their family. Again, this is the Wealth Planning Podcast with Brister Law. My name is Anthony Brister. We'll see you next time.